Hello, this video is going to go over the federal income tax and how they're calculated. Now remember, the federal income tax is a progressive system. So what that means is your income gets taxed on a calendar year. So it starts on January 1st to December 31st. Your employer will add up your income that you make during that time. And once the year is complete, by the end of January, the employer will send you a W-2. It's your earnings statement. So on the earnings statement, it'll have the income that you earned from that employer, and you use that W-2 to fill out your tax return. Now, when it comes time to actually calculate how much tax you should pay, you're going to use basically the tax tables that the federal government provides. So it's like a 20-page document. You just look up your income and it tells you how much tax you should have paid. But basically how they calculate those tables is based on this chart right here. And I think you need to see this to kind of really understand really how you're taxed from a federal standpoint. So the first $9,225 in taxable income, you're going to pay a 10% tax. So what that means is, let's say you make $9,225 for the year. Well, if that was the case, you can get taxed at 10%. And that's why then the next amount of income, between $9,226 to $37,450 of income, is going to get taxed at 15%. But remember, the first chunk is taxed at 10%, so that's why you see here $922.50 plus 15% of the amount over this amount. So, for example, let's say the person makes, in our example here, let's say the person makes, we'll go with $20,000 a year. So we'll write down the $20,000 a year. That's how much the person made. I'll do the best I can. I'm kind of using the mouse there. So they made $20,000 a year. Now you have to remember, the first $9,225 they pay a 10% tax on. So you want to figure out how much of that $20,000 falls in this range. So we're going to take $20,000 minus $9,225. Do the best I can here with my math here. And you get $10,775. All right, so that means out of the $20,000 that I made, $10,775 is going to fall under this range. Okay, so we're going to then take that $10,775. That gets taxed. We're going to multiply that. Gets taxed at 15%. All right, so we're going to times that by 0.15. And we $1,616.25. Now, what you now have to do is you have to add also the $922, because that $922.50 represents 10% tax on the first chunk of money that we made. So the first $9,225 is getting taxed at 10%, and that's how you get that number. And then the next $10,775 is taxed at 15%. And that's where you get the $1,616.25. So when we take those two and we add it up, our total tax is going to be $2,538. It's kind of hard to use a mouse here to write the numbers in, and 75 cents. All right, so there you have it. It's a progressive system. So it's not like all of a sudden I make $100,000 and I jump in from a 25% tax bracket to 28%. It doesn't work like that. It basically, each chunk of income is going to get taxed at a higher percentage the higher you go there. Now, the number that you'll hear in the news and the media, you'll hear what the person's effective rate is. So basically, to get the effective rate is if you take the amount of taxes that they should have paid, so in this case it's $2,538.75. If you take that amount and you divide it by the overall income, so in this case it's $20,000, when you do this, you're going to get what is known as the effective rate. So this is basically the actual rate that you're paying on your overall income. So when you do that, you get 12.7%. So someone who has put my decimal in there. Someone who has taxable income of $20,000 pays an effective rate of 12.7%. Now you have to remember, this is for a single individual taxpayer. There's different brackets for married people filing jointly, married filing separately. So there's different tables based on what you do. But for you guys, you're going to be single for a while. You're going to be claiming yourself. And you have to remember, the federal government allows you to write off a certain amount on kind of what you claim. So that changes from year to year. So if I kind of exit out of my presentation here, and I just go to, let's say I go to irs.gov. So I just want to see what the standard deduction here is. So if I go to 1040EZ and I go to the form, it usually shows me on the front of the EZ form. So right now, the first $10,300, if you claim yourself and you're single and you claim yourself, so that means you're a single person living in the city, you're no longer living with your parents, the standard deduction is $10,300. So what that means is the first $10,300 you make does not get counted as taxable income. Money that you put into a 401k does not get calculated for taxable income too. So it's basically your income minus the $10,300 minus any money that you might put into a 401k. That leaves you with your taxable income amount. So that will lower the taxable income amount as we go through. So after watching this video, I want you to go to a document and kind of practice this concept a little more. Thanks.